What is up, outliers? Time to get back to the markets. I hope you enjoyed your little stroll through Iceland. We still have a while left in that little intro video. I figure I would play something a few minutes early because it always takes YouTube a couple seconds to start, and there's always a weird lag, and I don't like that. So this is my workaround, and it seems to work pretty well because I always enjoy taking a peek at that stuff too. I realized it did it again. Every time it does this, I don't get it. But yeah, so I normally run around, grab everything I need before the live stream, and I already took my ibuprofen. I'm good on that front. I actually just started some peptide therapy, which I'm excited to see how that goes. And then yeah, waiting to fly to Florida to go see that specialist, depending on when Florida is done being engulfed by a hurricane. So first thing, let's go over the agenda really fast. There's a couple reasons why I made this one available to everybody. My intent is to make one or two of these available. It's not really a set number because right now for the pros, I do 3 live streams a week for them. And these live streams are really a little more in depth. It's kind of like talking more pragmatically about what I'm actually doing. And I think it's good for just other people to see that as well, because I used to do these style videos more broadly. And then there was a couple issues that started with that. And then there really has been a bit of a change in terms of the focus for the different live streams. So this is a chance for people to see like actually what I'm doing and get a sense of that, because none of it is a secret. It's all very, very much open-ended, nothing special about it, but it is what it is. So we'll start with a look through the broad market as per usual. I want to summarize a few high-level things. Then we'll talk about my portfolio, a couple things that we have going on, and then I want to review a trade. That's kind of the big thing for today. There's a trade that I have on that's gone interestingly. So I want to walk through that trade with you all, and I'm actually going to use on demand because I think it's a name most of you might not be super familiar with. And that's my hope, because I want to offer you a look at something that you might not know anything about. And I want to walk you through step by step, slowly moving time forward, essentially what's been going on, how I found it, all that kind of stuff, because it's also a pretty significant departure from the way that I generally would run the original intended strategy for it. So we'll get to all that in a little bit. Before we dive in further, you know, we got to say hello to everybody. So we got Zachariah, I'd rather be skiing. Reese is here. David, it's great to see you, man. David says, I'd rather be golfing, except skiing blew out my knee. That is super unfortunate. We have Elong Songs, Mike, and why not? Why the fuck not? You know what I mean? I get you. Why not? I'm right there with you on the why not front. Okay, so first things first, I need to grab the latest couple things from Morgan Stanley. I like running through their stuff because there's stuff that's applicable, I think, to us. So here's the email from Morgan Stanley, but this isn't like secret, right? Like everybody can sign up. This is their free stuff. And Joey says, wow, completely skipped me. It's cool. You didn't comment. You literally just commented right now. There isn't a comment in there from you, Joey. Wait, did you guys see a comment in there from Joey? That actually makes me kind of curious if it's not showing me. Because I don't see... Yeah. I literally ran through everybody that I saw. Oh, he's grifting. Okay, good. I was going to say, I'm just being trolled. That's cool. Because I was going to say, what the fuck? Because YouTube has been super weird. Somebody was telling me that the podcast that I did with Dave Lauer, they said that they were getting an ad like every 5 minutes. I literally had mid-rolls turned off. So it's difficult to know, honestly, like what YouTube is doing with what. And that's not like to blame them as like the boogeyman. It's just a platform that's being largely managed by algorithms and stuff. So Joey says, now I'm being gaslit. No, you're not, dog. Yeah, there's literally nothing from you in there, but now we're being gaslit. All right, let's take a look through this general update thing from Morgan Stanley really quick, and let's see what they have. So I don't want to watch that. Sustainable funds modestly outperformed. Sure, we'll take a look at that. How to plan a successful workcation. That's super dumb. What to watch on energy policy. I don't know about that, but let's see the election updates thing. Let's see what all this stuff is. Okay. As U.S. presidential election nears, tariffs and trade policy among the most sensitive to election outcome. Makes a ton of sense. Could have a notable impact on the economy in your portfolio. Okay. This is actually good so far. This is the trade policy is among the top. Yep. Impact of tariffs on the economy could be wide-ranging, pressuring consumers. Yep, okay. Kamala trade policy appears to be continuation of Biden's, but is still opaque, creating some uncertainty. Interesting. DJT says increasing tariffs on China. He's already talked about that. Universal tariff. Pressure productivity, growth, add inflationary pressure. Interesting. Investors can mitigate the impact of tariffs by considering defensive sectors. Oh, interesting. See, this is super interesting because this looks at the concept in a vacuum, which obviously this would not behave in a vacuum, which I can't help but find generally interesting. Zachariah says, dude, I got a shit ton of ads. Yeah, I don't get that. That's super frustrating. It's like literally super, super frustrating. I don't understand. That's so annoying. Whatever. Because it sucks that there's not even like really control over it. Because the thing is you can turn off ads entirely. But one of the problems is I actually think if you turn off ads entirely, YouTube doesn't push your video as much. Because then YouTube doesn't really stand to benefit from it. And then I noticed that sometimes they'll put ads on it anyway, then you won't get the ad revenue. It's really, really interesting. So yeah, very, very wondrous. But anyways, back to this. This is interesting because it looks like they're talking about, again, like this idea, like, I don't know if I'm trying to place a fucking tariff-based trade. You know what I mean? Like the election outcome in and of itself obviously will be pretty significant. But the issue I have with that is I'm not trying to make a trade thesis off of this because there's so many other factors that would impact things. So don't love that. But let's see. Yeah, this is what I was hoping it would have. So Kamala provided little guidance, not expressed a desire to change current tariff structure, indicates policies may remain largely consistent with Biden. Biden mostly upheld the tariffs originally put in place by the Trump admin in 2020. However, without more details from Harris regarding tariff policy could be risk. Okay, got it. Okay, so it already talks about this. Plans for an aggressive tariff regimes, raising tariffs to 60% on Chinese goods. Shit. Oh, shit. That's actually kind of a big deal. Not going to lie to you. Let me see. What is the U.S. tax on Chinese goods currently? Because that's not insignificant. Who do we got? I'm asking ChatGPT. That's what I'm waiting for. Apparently, ChatGPT's on a fucking coffee break. It's taking its sweet ass time. There it goes. Okay. Tariffs range from 7.5% to 25% on over 300 billion of goods. Okay, here we go. More recent measures have introduced 100% tariffs on EVs from China, along with 50% tariffs on solar cells and Chinese semiconductors. These more targeted tariffs took effect September 24. Also extended essential components like EV batteries and critical minerals required for renewable energy, tech sectors, which now face tariffs of up to 50%. Okay, so obviously big change lately in the tariff picture for it, interestingly enough. Okay, so let's close that out. Let's take a look at the sustainable funds quickly, see what they have here. Inflows while reaching 3.5 trillion in assets. I just want to see what funds they're talking about. Sustainable funds modestly outperformed peers during the first half of 24. Does it not reference any like specific? Lame. And lame. Okay. So that's that email from JP Morgan. Nothing too big to take away from it. The main takeaways I have specifically were the tax offerings from Donald Trump, just because there's some specifics there, and the fact that there's some uncertainty around Kamala. So nothing too pivotal, but generally, again, good contextual information. I noticed, and I want to reinforce for traders, a lot of the information that I use on a daily basis is not always direct information. It's the compilation of all of this indirect cursory background information that leads me to make different choices. So sometimes when I review stuff, I'll get the question of like, well, why look at that? Does that thing matter? It may or may not. But the way that I look at it is I'm trying to build a not super deep level of knowledge of everything, but I'm trying to develop a cursory level of understanding of all of these broader contexts. So that's why I spend the time looking at this stuff. Now, I'm just switching this so that it doesn't keep bouncing like it did there. I have a position on in here. We'll talk about that in a little bit. But let's get back over to the flexible grid. Now let's look at the market as a whole. What's going on here? A couple things stick out to me. One, tech is starting to show what I would consider to be a rally. I've already told you I have a position in NASDAQ futures that I'm trading to the upside. And for the last 2 days now, I've had to roll in the money short calls. I trade 0 DTE short calls against the NASDAQ futures. I use options on futures for that. And the last 2 days, I've had to roll them. So the only reason why I bring that up is because it tells me that tech is starting to grab a little bit of a bite. It's why I entered into the position. So I can grab my trade log really fast and tell you when the entry was. So it started on the 8th. So it was kind of, I remember when I first put it on, it was a little tentative. And the reason for that is because it was on this big green candle, this big push up out. But I knew that it was early because we hadn't broken above these yet. And we still haven't. But the reason why I started prospecting there is because I didn't think that the price action that I saw looked overly weak. And I didn't see a big change in total context in the market, meaning overall XLK, for example, if we take a look at that as a sector, is actually looking a little bit better here, right? So I can see tech here is starting to break up above. The reason why it's important to differentiate between XLK and Qs is the NASDAQ 100. It's not actually just tech. It's actually about as much tech as the S&P 500 is now. It's not too far off. And that's just a function of the weighting of the index and what it holds. But the NASDAQ holds other stuff. I know that surprises people a lot of time. But let's take a look, actually, just out of curiosity. NASDAQ. Let's just do QQQ current holdings. Because this typically surprises people a little bit. Oh, I lied to you. 50%. My bad. Way off. Way off. I thought this was closer to 35. So way off in terms of the relationship between SPY and this. Because SPY, I think, is close to 30 now. I think it's 26 and change or something. I'm probably way off on that too. We'll take a look in a second to verify what I'm saying. But so 50% is in IT. Then there's 15% in comms, which most of this would be considered tech to a degree anyways. Some of it, not so much, like Charter, Warner Brothers, like there's, media aspects to those, but we normally would consider stuff like Meta, Alphabet, Netflix. We would bucket that into tech mentally. So, I mean, really, you could call it 65-ish%, maybe 60% total tech, but it does have consumer discretionary, which again, has Amazon, which is very tech heavy, Tesla, also very tech heavy, but like Booking, Starbucks, PDD, Marriott, so on and so forth. The only thing I'm trying to show you is that there's other shit in here. It's much smaller of the index, but there's other stuff. So now I need to fact check myself though, because I want to see what the S&P 500 is currently at. So let's do SPY current holdings. I'm going to see if the spiders, see, that's so fascinating. When you look it up for Qs, you'll get the Invesco Qs offering. But when you look it up for SPY current holdings, you get all these random websites except for spiders, which I want their website. Here you go. Okay, yeah, so this is looking at SPY. Show me your stuff. Wait, I'm super confused. Oh, this is the Sector SPY website. Damn it. It's the wrong damn website. ER by ETF. All right, here we go. We'll look here. You look at its holdings. Here you go. So it is a little higher than I thought. These obviously move a little bit, right? As market cap and whatnot changes, the holders and the sectors will break down. So this actually, I still was completely wrong. Want to be abundantly clear, but it wasn't as off as I thought. Because if we combine IT and comms here, that takes us to like 40 versus 60. So definitely big variance. But what I'm trying to highlight from this perspective is that all of these are becoming more and more tech heavy. That's all there is to it. Everything that we hold right now from an ETF perspective is becoming more and more tech heavy. All right, so let's get this down. I'd rather be skiing says being wrong just means you learn something. It's all good. Oh yeah, I honestly don't give a fuck. I highlight when I'm wrong at stuff to try and show people that exactly what I'd rather be skiing is saying, is that it is completely okay to be wrong, right? Because if you look back a long time ago, SPY used to be like 15% tech, and then it hovered in the mid 20s for a long time. So it's like a lot of this stuff is going to be relative to whatever the benchmark is in your mind. But the other reason why I specifically flag those points is to try to also show you that I've been doing this stuff a really long time, and I still insist on fact checking myself because of that exact stuff. Because I know that what my subconscious brain might be anchoring off of might not be the latest stuff. It might not be current. And it's, even if we really think we know something or do something like really, really well or anything, like there's nuances that pop up pertaining to it. And staying sensitive to that is, I think, super, super important. So yeah, I'd rather be skiing is exactly right there. Reed says, I've really embraced being wrong. It's so freeing. I was always wrong. I just lied to myself about it. Yeah, most of us do that. And it's because, especially in trading with something like that, in a trading perspective, we tend to attach a lot of our ego to the comment of being right or wrong. And then it really entrenches us into our position. So I think that leads to a series of really, really dangerous thought patterns like anchoring bias, availability bias. So like getting over the fact of trying to focus on being right or wrong, what I recommend to people and what I do myself is I literally focus entirely on the pursuit of truth and just accuracy. That's what I care about personally. And if I have a thought about whatever it is I'm thinking about and it turns out to be incorrect or wrong, I'm cool with that as long as I can continue to learn exactly I'd rather be skiing saying. So yeah, I think ditching the entire issue of being wrong and attaching identity to it sooner rather than later is the way to go. And it really extends to just about everything, which is hard to adopt. But once you do adopt it, it really does become a lot easier to manage, because a lot of times people get entrenched in their idea and then they'll just dig deeper and deeper and deeper. I've had plenty of discussions with people or arguments. And again, argument gets a bad rap. It's just the exchange of ideas, right? It's not argument has a bad connotation, but when I use it in this context, it's not bad. I'm just talking about two opposing ideas batting back and forth. And you can tell the difference between somebody that's trying to explore for truth and somebody who's trying to prove their point. And the way that we structure arguments in those two different things is completely different. So in the world of trading, I think pursuit of truth is hands down the easiest way to go. So let's take a look now at the sectors. Busy Blends says, what's the importance of this information? Which part are you talking about, Blizzy? And then happy to give you the why we look at it. Let me know. I don't know if it was the philosophical thing we were just talking about. I was talking for a minute, so I'm not sure when you sent that in. But yeah, happy to give you the thoughts if you just let me know. But looking across the different sectors now. So we can see a few pretty big changes going on. Real estate continuing down. This trend is confirmed and then some at this point. So this is a very tradable movement. I'm not fading it because I'm in other stuff that we'll talk about. But the other thing to note is, for me, I typically don't trade XLRE. I bring this up for general context because I have, and this isn't like it's the real term. I have real property, right? So real property is like physical buildings and stuff. It's literally called real property. So I don't really trade too much real estate in the trading portfolio, although it does present good opportunities at times that I will dabble into. Most of what I do is other asset classes because I already have exposure to an asset class. And within the real estate asset class, I have several sub asset classes within that. So think of it like SPY has all the different sectors and they'll behave differently, just like we're looking at here. It's the same thing for real estate. So I already have exposure here, but I highlight this because it still does look like an interesting opportunity to me here. And for a lot of other people, the relationship between real estate and equities is pretty well defined and scoped. So it can offer a little bit of a stabilizing effect to a portfolio. So that's what's going on here. Blizzy says, knowing why an index has a larger percentage of tech or not. A bunch of different reasons. But so let me ask you this question. Is it Busy or Blizzy? Busy. So Busy, if let's say, for example, we see a headline or something and it says that the NASDAQ is down today. What can you infer from that headline? And then I'll give you more of an example beyond that, but just offering us a starting point here. So if we hear NASDAQ is down, what can we generally infer? Cedric says you need to check NASDAQ. Maybe. Not necessarily, but maybe. And then for Busy, what I'm alluding to here is just the fact, exactly, Reese has it, is that tech is probably down to a degree. So now let's then think of this. Let's say I'm holding a portfolio and I have long SPY, meaning the S&P 500 index ETF, most commonly held ETF, plenty of people hold it for broad market exposure. And I see news that tech is now starting to contract. Well, maybe I know now that SPY is like 40% tech, give or take. That's actually kind of crazy to say because you would expect it to be much better balanced than that, but it's not. So let's say it's 40% tech. That means that this ETF that you're holding is likely also going to be pressured to a specific degree. So then maybe when we're shopping for other trades, we look for stuff that can offset that hurting position within our portfolio. Or maybe if you're like me and you don't really have long-term holdings, at least in your primary trading account, in that scenario, maybe I start looking at tech to start fading it and follow the down move. Now, again, it's different here. Tech is actually up. But what I'm highlighting is that if you understand the structure of these different ETFs and stuff, is it helps create a better understanding of building a portfolio that makes sense together. Now, if you don't trade any ETFs, then that information is just general context for you. And it's the kind of thing that if you hear a news article or something that pops up and says, oh, the Qs are down, well, then you can kind of just take that as NASDAQ's down, and NASDAQ down, tech down. You just kind of know that in your back pocket if you're not trading ETFs or have some sort of specific disposition towards that sector. So the main thing is it provides understanding. It gives you two different levels of understanding. The first level is, again, just market level data. And then the second, ideally, is that it would help us think about how we might want to configure our portfolio. That's the idea. So Mike says, thoughts on driver behind the XLRE downtrend? Yeah, it's a great question. So I think a big part of this is the issues that we're seeing with the rates. I think that we first started seeing a bit of a front run into this rate cutting picture that now is starting to look very different. And it is 100% worth noting. So if we take a look at the 7-Nov meeting, which is coming up, less than a month now, and we look at this probability of no change, it is skyrocketing. It was straight up 0% on 2 October, 4 October, 4.56%, I'm sorry, 2.56%. Then it jumps 15.6, now 19.75. So that's probably a big part of this, because you have to remember with a lot of real estate, and especially commercial real estate, is commercial real estate rarely uses 30-year fixed mortgages, right? That's just not how those kinds of deals work. Most of the time, it's some sort of five-year rate that is adjustable after the 5-year period. So these kinds of things impact commercial heavily. Then you layer on the fact that commercial real estate tends to be really levered. The understanding the leverage of real estate is so understated by people. I think that's why it's a grossly misunderstood asset class. It was for me for a really long time. I didn't understand real estate at all. And that's because I grew up fucking poor and none of us know what this shit is. But then as I started realizing how different real estate asset classes behave and then the leverage associated with them, it is quite literally tremendous. So all of this tying back to real estate, I think this has a lot to do with it. I think the market's perception about rates in different periods is very, very telling. And let's take a look, for example, we'll pop over to the main chart. And then let's take a look at the 10-year. This is the 10-year yield. Why is the 10-year yield fucking skyrocketing right now? Why is it over 4? It shouldn't be over 4% right now. So the market right now is showing a complete disparity between what we are expecting as a trading market versus what we're expecting from a rate environment, which is, again, it doesn't look good right now. That's for sure. So Mike says CRE is a mess. I actually don't think so. I think commercial real estate is looking really, really good right now. A lot of my holdings in commercial real estate are doing supremely well. Again, I think for people, it's so important to remember an asset like commercial real estate, it's a really, really broad bucket. And there's a lot of stuff, a lot of different sectors that can go into commercial real estate. Because one of the first things I hear when people say, oh, like commercial real estate's not going well right now, is they'll just jump right to, well, what about office buildings? And office buildings are doing terribly. It's actually one of the biggest sources of great deals right now is buying office buildings and converting them into other kinds of property. But the main point here is that that's one sector within commercial real estate. There's a lot of sectors. So I would always remind people that there are elements of strength and weakness just about everywhere we look. Mike says a lot of debt coming due will need to refi in current rate environment. Definitely. Absolutely. And I mean, the current rate environment is it's not crazy. Like that's the other thing people need to understand. I think we have gotten way too used to this insanely low rate environment. And there absolutely is a period where a good rate was mid 5%. Like that is completely normal. So I think the reason why you might feel that way, Mike, is just because of availability bias. That's exactly what that is, right? We're looking at a certain stretch in time thinking that this is now the norm, but it really isn't. If you look at the overall period going back into the 80s, not that long ago, even the 70s, even more so, but you'll absolutely see people completely normally dealing with 5-6% loans. Like it's very normal. So I think a lot of that is just an artifact of people getting very used to how things are today. David says, high enough unless you had a mortgage in 1982. There you go, David. Tell him, David, you know all about this shit. Let's take a look at commercial real estate rates. Start. I want to see if I can find, there we go. What is this? Interest rate and price indices. This is price level. This is not what I want. I want yield. Commercial real estate loans. Here we go. Multifamily real estate, no, price index. Damn it. I'll find it later. I don't want to spend too much time on it. There's Fred has a yield chart that we can look at. David says 18.875. Yeah, it's like that's fucking crazy to the upside. That's supremely high. David, when I'm actually really, really interested, David, for your, damn, that's fucking crazy. David, when you saw rates at 18, almost 20, was the perception then, like, did you guys acknowledge and understand that it's really, really high? Or was there a perception of like, this might be the new norm for us and it just kind of is what it is? Because that's, I mean, you got to think about what people can afford even at a fucking 18.75% rate compared to, 8%, which would still be relatively high. That's got to be crazy trying to figure out. David says, oh yeah, it went higher. Okay, so you guys kind of like knew that at least for a while it was going to be hanging around there. That's nuts. That's absolutely nuts. Interesting. So looking at sectors, what's showing strength? Communications, energy is ticking back up. How is energy doing right now, actually? Crude is down a little bit. I already got stopped out of the crude trade, but I keep looking back at it because I still want exposure to crude, but it's not at a good spot for me. We have financials, which are doing well, approaching highs. We have industrials hitting highs. Tech, as I already said, is actually starting to break out from these other highs, which is great, right? Because higher high, slightly higher high. Now we're already making a higher high, low, higher low, higher low. So that's a clear change in paradigm, which is good. And then real estate we already talked about. Utilities are still rolling over. This is a great spot, I think, still for shorts. And then healthcare is starting to grab a little bit of a bite, but I'm curious if it'll rally up to this prior high or not. So I'm keeping an eye just within the healthcare sector. And you'll see as we look at a couple scans that I still don't think healthcare looks all too great, at least in my opinion. Now, peek back over really quick at the indices, net highs, lows, as you know. NASDAQ is showing really, really muted performance, and it's actually starting to rotate down. So looking down at net highs, lows, the thing that I find interesting is gross highs is contracting, gross lows is expanding, net highs, lows, obviously turning negative, but this has been very, very muted for some time now. So this rally is being thinly supported. That's what I can tell you within something like the Qs. And then small caps, this still remains to be quite the anomaly, because looking across the New York Stock Exchange, we definitely have contracting net highs, lows. Lows have been, pegged essentially low, right? Gross lows is tiny. It's not moving much at all, but we're not seeing any sort of follow through in small caps. So to me, that means that we're not seeing stuff advancing lower for small caps, but we're not seeing a bunch of stuff advancing higher either to really drive net highs, lows up. So breadth in this is actually still very uniform to the upside, but it's just weak. It's not enough to move the sector, which is quite interesting. And then S&P 500% above 50-day moving average is hovering low 70s. It's tagging and then closing typically high 60s or so. So that is okay, provided that it doesn't start dropping below this. If it starts dropping below this, it really doesn't look good. But the other thing to remember when using something like the percentage above 50-day moving average is a big piece of context is not its natural level, but it's also the rate of movement. That's super important, because the rate of movement supersedes, in my opinion, the natural level. It can be at a lot of different levels for different periods of time. So I'm less jazzed about that. Bonds, we already talked a little bit about the bond picture, but they are still getting, the 30 years are, or I think this is 20, they're getting just mangled to the downside, which again, I can't help but find that a little bit interesting given the current environment. So yeah, it was a 30-year. I forgot ZB. So this really begs the question, cut. Is there going to be a cut, and what is it going to look like? So I'm actually going to ask you guys. So let's do 7 Nov and let's do cut or no cut. This is for the Fed. We'll let that poll run for a second. You should see it in the chat now. Let me know what you think. Right now it looks about mixed. I see 57-43, 50-50 now. 56-44, 50-50 again. 56-44. Interesting. Yeah, because, if I were to vote in this, I would still vote cut. I wouldn't vote 50 bips. I would vote 25 bips, but that would be my take. But I'm really surprised to see the number of people are expecting no cut. That's fascinating to me. Because for me, I'm not going off of like my qualitative assessment. I'm literally just going off of bond market pricing. So very interesting. I'm going to kill that poll. Thanks for checking it out. Very interesting to me. Cedric says because of Fed comments. The Fed is only part of the picture. And again, the Fed... The minutes that just came out are just, more in depth of what they gave us during the FOMC meeting itself. So I don't actually think that we got some sort of like big burst of new information that has led to repricing. To me, this just looks like as we get more and more economic data rolling in, there's a lot of different opinions about it. What's today? Thursday. Today's Thursday? Jeez, this week went by fast. Shit. All right, let's talk a little bit about the portfolio really fast. And then, so right now I am sitting at just over 200% utilized. That's including some box spreads. And those box spreads are going to come due on the 18th. So those come up next, what is that, next week? Yeah, next Friday. So those box spreads will probably get laid out again. And I need to recompute what the current yields are. But right now for like 30-day yield, what is it, like high fours, I think? Or it's got to be a little bit lower than that now. I haven't ran this. Let me run this really fast, actually. And again, for those that have downloaded, you can go to the shop and you can download the little thing that I use for free. And I purposely made it so that it's like super easy to update. So literally all you do is you pop into the link that I have built into it, and you just come in here to where it says symbol. You just highlight all of this, and then you just dump it in. Okay, so they're a little bit higher, and that's interesting. So right now 30, yeah, so it's still high fours, 4829. What was this before? Out of curiosity, I'm gonna undo. So that's the same. Whoa, interesting. Let me show you these two. I need to grab something for you. Hold on. Let me grab this. And then I'll show you the change in the curve. I'm going to grab a screenshot for you. I missed it. Here you go. So there's the curve as it sits. And then here's the updated curve. Here. So if we compare them, you can see that the midterms really tucked up a lot, a whole lot. The other thing I'm going to do really quick is I'm going to change the scale. Just because I think it'll be a little easier to see, because I mean, we're probably not going to see 1%. I don't think so. So we'll start it at 1. I might take it even higher. That's fine at 1. I'll drop that in a little bit later. So what I'm seeing here are the 2-year got sucked up. The 2-year was at 3.576. Now it's at 3.95. Damn. The 3-year went from 3.494 to 3.872. So yeah, all these expirations really started getting sucked up. So that's going to be something to keep an eyeball on, especially if you maintain any sort of bond allocation to the portfolio. I think keeping the exposure that you want, that's going to maintain across terms. This is actually something I'm working through with a couple family members right now that have bonds in their portfolio, but they use them more so for income. So they're not looking for, they have 0 coupons, and they have a bunch that are coming up that we're going to have to figure out to regain exposure. And now actually it looks like a better time than I would have expected from before to get into something like a 3 or 5 year for them. So yeah, very, very interesting stuff to me. Now back to the portfolio. Reese says, can you explain how your 200% utilized seems like twice as much as possible? Leverage. Yeah, that's all. So right now for futures, I'm mostly trading E-minis, Qs. The Qs position is still being pretty tight managed. And then, like I said, I really would love to get into crude, but I just don't see it right now. I love this move. This is the move that I traded into crude. And actually, if you take a look at this kind of pattern here, this is going to look familiar to you when we go through the trade study in a little bit. And from here, it still looks strong, but from here, the stop has to get moved up a bunch, and I don't necessarily love it. So this, I'm just kind of like leaving sleeping dogs lie and just let this do its thing for now. I think there's other opportunities. Now, nat gas, this starts to look interesting to me. because nat gas, I think you can make an argument if it starts showing some sort of strength above here ish. I kind of like that, but it's still a little early to tell. But this, I definitely don't mind. So Reese, let me know if that answers your question. It literally is just kind of the simplest answer is it's like purely through leverage. And Mike says, do you aim to generate 30-day yield with your box spreads? No, not at all. The reason why I created that tool is so that I can essentially compare it to the comparative period for the risk-free rate, right? Because I could even include something like SOFR, something for shorter term box spreads. But for example, if I'm doing a box spread that runs 45 days, well, then I'm going to compare that to something between the 30 and 60-day yields and see how I can do compared to those. So for the box spread that I put on, it was a 31-day. So in that case, I will use the 30 days as my reference benchmark, which again, when I put it on, it was 483. And then I was about half a point better than the 483. So that is just the small premium for going into something like SPX versus just buying, the most convenient version that exists. Cheetah of some baby oils. That is a hilarious. What a fucking name. I absolutely love that name. Do you ascribe to the Phil Mianis call diagonal principles? Literally, I have no idea what that is. So clearly no, because I've never heard of it. I have no idea what that is. If you let me know what they are, I can weigh a little more carefully, yay or nay. I can show you what I do for diagonals. I have a playlist on them. Let me see. There it is. Ratio diagonals. Here we go. Mr. Cheetah, you can check out how I run diagonals there. Joey says, I can never set up box spreads correctly in SPX. Never looks correct on the Analyze tab. Did you watch the video? I have a video that walks through literally step by step how to do them. It's just a big spread. Here is Joey. This is the first video just on box spreads explaining them. And then this video explains the box spread trade log. But yeah, I mean, they're super easy to set up. I'll show you really quick. There's nothing to it. So if you go SPX and let's say that we want to do a box spread, first thing for box spreads is what kind of stuff do we trade for box spreads? There's a couple really important notes so that you don't end up like a Reddit GIF or I don't know if it's an unsung hero because he's pretty much known by everybody. European expiration, that's exactly correct. What else? We want European expiration, no doubt. We also would like something, ideally, we want something that, let me see, cash settled, exactly. So we want something that doesn't settle to an underlying itself. We absolutely want something that is cash settled because one of the big things is you want to hold it in expiration. Now, there's actually another element that matters to us. So when we're trading box spreads, if you can trade something that is section 1256 of the tax code, you're going to be better off. So that's just another general consideration to keep in mind is I prefer trading things that will give me slightly better tax treatment. Again, depending on if you're flagged as a full-time trader with the IRS, you have some slightly different rules that will apply to you that can be beneficial, but using something that's section 1256 is just generally smart. It'll be a little, it's just simple as trading the indices is what that kind of boils down to. David says, doesn't matter for Canadians. Well, honestly, that's what you get for living in Canada, because it doesn't surprise me in the least that they don't care at all about any of that. So they just kind of just screw you, I suppose. But that's how that goes. Mike says, anything non-futures that fits that description? Yeah, if you check out those videos above, it'll go through it in detail, but SPX is one of them, right? This is a cash settled index European style. So here, let's go to, let's say we want to do a 35-day box spread. Probably have to be pretty wide. I normally do them something like 1,000-point wide. You can go narrower if you're looking for, let me see. I'm just eyeballing what I can see up at the top here. So we can go to like 61. So we can run from like 51 to 61. We'll have to go a little bit more. Right now, I'm just checking for liquidity. This is like a super, super fast eyeball test. So I can see 1,000. The deeper in the monies are going to be the more problematic ones. So it's 53. So if I can do like 53.63, that would be okay. How did the 63s look? 880. Oops, here. 5,400 to 538. I don't love that, but that might be okay. So right now I'm just using OI to assess liquidity. And the process is simple as, so we're going to do 53 to 63, I said, right? So we'll buy the 53, sell the 53, come out here to the 63, buy the 63, sell the 53, analyze. That's your box spread. Done and done. So you'll notice that it has no loss potential, as it shouldn't. And essentially this one box spread here, the value of it is 100. Joey says mine always shows a negative loss. It means you're probably just inversing the right? Because if you do the inverse, so in this case, instead of buying this, if I sold it, which would be the difference if you click the buttons wrong, is that it'll show it as a loan. So that's my guess, is you're probably just fucking up the buttons. So in this case, this box spread is worth $100,000. If you got to fill at the mid, you would essentially put up 99,520, and then you would receive the full 100,000 back at the end. Essentially, you're giving a loan. That's what this is. This is just a loan. And it's a way to make something slightly better than the risk-free rate. That's all there is to it. So, and again, you can size these to be whatever you want. The reason why I go wider like that is so that you don't have to put on as many, but it balances liquidity. Because if you try to go out to something that's like 250K wide or 500K wide, the problem is that they're so far away that there's just no liquidity there. And then you'll get murdered on the bid-ask spread trying to get your fills on fewer lots even. So there's a really, really big balance between the width and the liquidity. Sometimes you can even go a little bit narrower, but if it gives you a slightly better spread, it can absolutely be worth it. But you just kind of have to eyeball it. Again, that's why when I went through the example here, I was essentially just taking a look at the open interest, because that gives me an idea of overall liquidity, right? So like the 52s here, these look good. And again, the ones that are further in the money, that's what's going to give you the problem. The stuff that's out of the money at an even expiration, these typically are not going to be any problem, right? So like 30, I don't know if I said even expiration. I don't know why I would have said that. Even strike. So something that ends in a 0 or a 5. That's just human tendency. As I talk about that a lot too, right? So 51.25, 31K, and then you literally skip until you get to 51.50, and that's just kind of how it goes. So anyways, yeah, that's the box spread. Super simple. All right. So let's talk a little bit about this trade that I want to review with you. And I've actually talked about this trade a couple times with the pro members. I'm going to take us back to 10 September, and I'm going to show you the market. And then the intention behind this exercise is literally to show you what I came across and how I've traded it. And now the trade is still on, but I'm at a really interesting decision point. Before that, I forgot. I needed to talk to you about a loss that I took. I never miss an opportunity to talk about a loss. Nike. So Nike this is using real time now. So Nike, I placed a trade. I forgot exactly when I put it on, but it would have been somewhere around here. And the trade was actually working pretty well. And I was running it to the downside, literally just trying to get it down to this point. You can see where the stop was set. And this was going to be a ratio put diagonal. So I put it on. I maintained a really light ratio as per usual. I get two kind of sideways days, which makes me a little bit concerned. Not a big fan. The movement itself was okay, but not great. So then we get a little bit more of a follow through day on 7 oct. Then we fast forward to 8 oct. It grabs a bite and it's shallow. I was expecting this to continue down more. So then next day, I was looking to see if it would open around here and actually start rallying back down, right? So like first green day doesn't mean anything. It can have a green day. Even this green day didn't necessarily mean anything except the fact that it was a one-sided shot up. So I actually exited here. And the reason why it was a loss is, if you'll notice, it was actually just a little bit lower than where I entered. Do you have a guess as to why it was a loss? And when I say it was a tiny loss, but I'm just differentiating. It's actually funny. The way I look at it is, if I have something that's like a few $100 gain, I'll just call that a scratch. But as soon as it's like a $5 loss, it's a loss. So this wasn't a big loss at all for the size that was on. But I want to use it as a case study, quick case study. So why do you think I would have lost here? And vol contracted not so much, a little bit, but not too much from when I entered, because I was using longer dated options. So vol absolutely contracted on the 30-day vol, but I'm out further than that. So vol didn't move that much. Any other guesses as to what would have led me to taking a small loss here? Theta? Nope, not theta, because I was far enough out and really time hadn't necessarily ran that much. So not that either. Bingo, Mike has it. That's exactly correct. Liquidity. Fucking liquidity got me. So what ended up happening is, as I was trying to take this exit, literally, in order for me to get a fill, I had to give up what little bit of profit I would have taken net fees. I literally had to give it up, which is super frustrating. So lesson for everybody, because Nike's liquid. I'm not even talking about an illiquid product. If we go out here to the 70 DTE options, like for the out of the monies, these are 10 cent wide, these are 10 cent wide, these are 16 cent wide. So it's not even that illiquid, but that's just how close my margins were when I was getting ready to exit. Again, it's a super small loss, but good case study on liquidity. So now let's take a look at the case study. If we go into on demand, again, I'm going to show you what the market looked like at this point so that you have your bearings about you. We'll take a look at SPY. And this is a trade that again, it's worked out a little bit differently than expected. And I want you to see it. So I'm going to pause time here at 0935. I'm going to move us back to shortly after the open. We'll do like 0635, something like that. Let that load. Boom. Here we go. So this is post-August drop. And you can see that the S&P 500 took this on the chin from 565 down to 510. So about a 10%, that's a correction. And then it started this one-sided rally up and out, off to the races it went, grabbed a bite, was starting to rotate sideways, started to contract down, again, finished its consolidation after this rundown, and it looks like it's finding its footing. Okay, so there's a stock that popped up on my radar that I had a couple alerts set for. It's an APP. So this is the stock. Now, the reason why it popped up on a couple of my alerts came down to essentially three things. The average daily range was wide. That is how I find stuff that's moving more, right? I'm finding things that are accelerating intraday. The second thing is it popped up because of this move here into a consolidation period. So this is going to be, for me, I'm targeting a breakout. That's what I'm starting to scope here. So now from here, because essentially we ran from 60 to 90, it's a massive move in a relatively short-term time frame, especially for something like that didn't fall quite as heavily as the S&P 500. It went from 87 to 60. So big giant move up out. Started consolidating, and you can see where I set my entrance for. I'm very interested if I can see ideally a close above this level. Any questions so far on what I saw and how I saw it? Pretty simple. There's nothing crazy about this. It's literally just looking at something that had a big move and started consolidating. Paulo says some options have extremely high volatility but low liquidity. Do you ever trade those? I avoid low liquidity. Low liquidity will kill you. It takes any, like for your example, and also I don't really care if something just has high volatility. High volatility itself doesn't draw me. It doesn't make me leave. It's just an input. But liquidity has to be there. The reason is you can essentially just, the primary reason is because most people think about what it's going to be like getting into a trade, and they don't focus enough on what it's like getting out of the trade. So there's a really big function for making sure that there's liquidity in what you're looking at. So sometimes I'll trade less liquid stuff for sure, but I'm not going to trade those at size, and I'm not going to trade something I'm expecting to have to touch a lot because, again, low liquidity will cheat up. Cheetah says, how do you know if the chart might stop moving to the right? The beautiful part is that other than death and taxes, the next thing you can add to that list is chart goes to the right. It's kind of the beautiful part, because maybe you're like me and not good with directions. I'm kind of unidirectional. So yeah, it's really convenient that it will always go to the right. So let's fast forward a day. We have 11 September. So the day starts relatively normal. Now, I have to wait for it to populate because I want to show you something. But the day starts essentially looking like it's going to rally. And the reason why it looks like it's going to rally to me is because it started here, had a tiny little sell, and then immediately started rallying up. It hit a high of 90, came back down, and you can see that it's essentially oscillating in here. Okay, cool. So now I'm actually going to fast forward time instead of days. And I'm going to take us to 0830. And again, this is all Pacific time. What do you notice about this candle? There's obviously a very important feature beyond the fact that it's going up. The up is part of it, obviously, but there's exactly, David has it. It's one-sided. So it had very little dip after the open, started rallying super strong. The other thing that I noticed right out of the jump is that if I take a look at the total volume that traded, 2.3 million shares at 2 hours into the open. And then if I look at the 5-day average volume, it's 3 million shares. The 20-day average is 3.1 million shares. So what's the next thing that you can tell me about the volume that I noticed? Because that is another super important factor when I look at this. Because when I'm looking for breakouts and things that look like they're going to be breakouts, I look for stuff that is super heavy volume, that shows lots of people buying. So the probability, even though the day's not done yet, the probability of this ending with volume right down here where you can see it in the bottom left there, with volume that exceeds the averages is exceedingly high because it's already almost pacing them 2 hours into the day. So this ended up popping up on my alert because of two reasons. But the main reason wasn't actually volume. It was just intraday move of 5%. So I have a scan that sends me stuff that have options and are moving greater than 5%. So this was already on a watch list and I'm essentially just looking. Now I had an alert set here at 92.94. That's where I would start scaling in if I got a close above there. So it's still too early to enter as far as I'm concerned. But now this is on my second screen, which I essentially just start watching. And I'm going to keep my eyes on it. So now if I fast forward another hour and let this finish buffering, I'll walk you through the next thing that I see here. So far in my mind, this is just a breakout play. This is one of several breakout plays that I'll maintain at a given point in time. I'll normally look for breakout, either upside or downside. I'll look to those. I'll try to maintain 3 to 5 of them, at least 3 in the portfolio if I'm trading them. So I see it start posting this high. So now I have a choice. The choice is, do I wait for a close or do I enter now? What do you guys think? That's the first decision point we have to make. So I'm going to start a poll. I'm going to add trade entry. I'm going to say wait for close above or enter. Let's see what you guys think. Now, as I told you in the beginning, the plan tells me I'm looking for a close above. And the reason why I look for a close above is because I want to make sure that the price level is held. That's super important. So now we're at a decision point. So we have 9 votes, 56% say wait for a close above, 44% say enter. Cedric says, Ayo, you need to wait on the poll. No way. I asked your opinion. I'm just sharing my opinion. My opinion shouldn't be your opinion. You should have your opinion. So we have 58% that say wait for a close above, 42% that say enter. And then, okay, cool. So now we'll do another poll of what did Eric do? Enter or wait? Let's see what you guys think here. Did I enter or did I wait? Oh. So we have 10 votes, 70% say enter, 30% say wait. Interesting. So for those that think I entered, why? 73-27. If you think I entered, explain to me why you think I entered. Especially because the majority before said wait for a close. So I'm curious. David says volume. Joey says discretion. Well, discretion is what would lead to the override. But what do you think I would have based the override on? Mike says because you have something else to share that you noticed. No, not really. Not yet so far, at least. I'd rather be skiing says breakout with one-sided volume. Cedric says because we lose money, so think you do the opposite. Reese says you said you'd wait for a close, so wait. David was on it right from the jump. Volume completely overrode. Original plan was wait for a close. Fuck it. There is one-sided buy volume that is already exceeded the 5 and 20-day average. It's already crossed above the threshold. I buy. So what's the caveat here? Well, the caveat is this is now a very speculative entry because I'm buying it here. Yeah, that's actually a great point. So at David, you do get plus fake 1 internet point, a key. And then you asked for a cookie. Let me see if I can find one. Ooh, I have something better than a cookie. Hold on. I got to get a little closer. What can I give you that's slightly better than a cookie? There's a certain... That's interesting. No. There we go. Bam. Give you some venison. There's a deer. So you are welcome. So this entry became completely different than what I typically would do, but it again is for that very specific purpose. So now what I'm going to do is actually walk you through step by step what this looked like. You know, it's got to be with artwork. There's no way I could do this any other way. That's for a video that I'm getting ready to make for you guys, but it's definitely not done yet. So because this is me talking about my stuff, I'm gonna use gold. And I need to get the mic slightly out of my way. Okay, so what I'm gonna do to make this a little easier from flipping back and forth a bunch, I'm gonna walk you through the process. Okay, so what is the process? Well, the process is very simple. At a very high level, I already needed to check first the economy. I need to look at the market. Then I need to look at the portfolio. So we already did a quick look at the market via S&P 500. The reason why I mentioned these steps is just because these should not be skipped. This is part of every day as I'm deciding what I'm going to trade, how I'm going to trade, what I'm looking for. These are the very first two steps because they paint the picture of what I may or may not need. So then I look at the portfolio and I say to myself, do I have a need or do I have space? Portfolio need simply means, do I need to gain a certain metric for the broader portfolio? So this looks like, do I need to gain theta? Do I need to gain gamma? Do I need different beta weighted deltas? That's portfolio need. Or there's another one, which is just risk. Do I need to use more money? And at this point, the portfolio, unlike most of your wives and girlfriends, had no needs. The portfolio was happy. So that tells me then I get to look at scenario 2, which is space. This simply means I have room to add things. So let's take a look. We already talked this. I got to move my little... change the order. There we go. This is T1. Trade entry. Let's talk about that trade entry. What do you think I did? The profit mechanism, as I see it here, is what? I already explained it to you, but I want to help teach you how to define profit mechanisms because I know it's a different way of thinking for a lot of people. So what's the profit mechanism here? There's kind of two levels. We can start with the very basic level, and then we'll get into the second level, which I think is important to differentiate. Joey says breakout based on consolidation, range, and volume. Yeah, that's good. So profit mechanism as a whole equals price up. The sub mechanism equals breakout. Why does this matter? Why do I think about the profit mechanism and the sub profit mechanism? Why does that matter to me? Reese says stock go up. That's beautiful. It's exactly correct. That's the profit mechanism. Price go up. Bingo. So if I'm trading something price is going up and the sub mechanism is breakout. Cedric says, otherwise it's just 10. Yeah, that's right. David says, determine trade strategy. Bingo. Okay, so then talk to me. If I present you this as my profit mechanism, what strategies make sense here? Now, first, actually, let me take a step back. What are my expectations? So if I say price up, breakout, what are my expectations for the movement of the stock? What's the point of the entry? What do I think the stock is going to do? So again, you have to adopt my lens here to talk about it from my perspective in what you think. Long calls or stock. Yep. So I think that's fair in terms of strategies. I'd rather be seen as follow through. Okay. So let's be more clear. Oop, that's the wrong yellow. Hold on. So we're looking for follow through, but be more clear. I want you to think about why this matters, right? So David already told us it matters because it's going to help me understand trade strategy. So then if I expect follow through, okay, that's fine. But we need to be more specific because based on what I think it might do in this follow through path will influence what strategy may or may not make sense. So Joey says short-term price target up somewhere informs if you want capped risk or limited upside. Yep, there we go. So Reese says participate in stock go up. Yep, exactly. So the reason this matters is because, and to define what it actually looks like in terms of expectations, is because it's going to change what I put on. So what do I expect here? I expect follow through. That's completely correct. I expect velocity. And I expect volatility. Why do I expect velocity and volatility? Because I've studied tens of thousands of breakouts and I know the way that these go. Either it's going to hover around here for a day or two, maybe a couple days, and then it's going to plummet, or it's going to grab a bite and start going. And when I say grab a bite, that just means traction, right? When something gains traction and starts moving. But this all summarizes to aggressive aggro in surfer speak, aggro movement. So now I've just explained to you what I saw, what I analyzed it as, what the profit mechanism is, what the sub mechanism is, what does the profit mechanism and sub mechanism actually mean in an interpretive qualitative picture. So now what strategies make sense based on what we've just reviewed? What strategies fit this idea here? And again, we've already reviewed that there's no portfolio need. So I don't have a need for any specific kind of risk. Joey says long calls. Reese says long call, short put. So I see long call, I see short put, I see ratio call diagonal. I see Skiing say he's on size. I don't want to talk about size yet. So let's talk about these. The other one that could reasonably fit here is long stock. First, if I'm expecting aggressive, exactly, David is already on it. So David says no short put gives up upside. That's exactly correct. So short put is not valid here. The reason why it's not valid is because if we look at the P&L graph of a short put, it's going to look like this. It should be completely flat. I can't draw a completely flat line. It doesn't look like that. Doesn't look like that. Okay. So for the sake of not confusing anybody and trying to be accurate, it will look like this. So that's why short put doesn't make sense here, because I just went through this analysis. I qualified the profit mechanism as breakout. I've already said from a qualitative picture, I'm looking for follow through, velocity, volatility, aggressive movement. So this, if I get this, if this happens, this, which is a short put, doesn't let me participate. It doesn't let me get what I want if I'm correct. I want to take a pause here, and I want to really highlight what we've just done. The reason why what we've just done matters so much is because most traders spend a ton of time thinking, what strategy should I do? What makes sense? And I don't think that they realize it makes a ton of sense. Once you go through a flow like this, it's going to back you into a trade. Joey says, I guess technically a long straddle could fit if unsure on direction. It could. Obviously, this I'm talking the inference, right, is profit mechanism. We already talked about that as price up. So straddle, I wouldn't, or a long straddle or strangle, I wouldn't run here because I'm not trying to trade price move. I'm trying to trade price up. Again, this is why using this concept of profit mechanism and sub mechanism is so useful, because it starts to solve this problem for you. And when you're new to trading, it's a big problem. It's really difficult to sit there and think of what makes sense when for you. And this solves quite literally exactly that to a T, because it's naturally going to back us into a few things. So now let's talk about it. Long call, long stock, ratio call diagonal. How do I decide between these? What's the easiest filter you can think of to compare long calls or ratio call diagonal? We'll call these equivalent to long stock. Any guess? There's one super easy filter to start with. Well, there's actually a couple as I'm thinking about it now. There's one even easier filter than I was thinking of. Leverage. That's not it, actually. Good guess. That'll definitely be one of the inputs. But technically, you can get leverage with long stock. You can trade on margin. Reese says no ratio call diagonal eating into the upside. Yep, so I agree with that. That'll get filtered out. Well, no, it's not like covered calls. Just to be clear, Reese. It's not like covered calls at all. Ratio call diagonal preserves the upside. Joey says max risk. No, I mean, technically speaking, I could size them the same. I could say I'm going to put $5,000 into the trade. And then if it's $5,000 worth of long calls or long stock, it's still $5,000 at risk. So that's not it. Think even more simply. What did we spend time talking about before that's super, super important? Potential max return on the upside? Nope, that's not it. Good guess, but incorrect. We spent a while talking about it before. What is the thing that hurt me on my Nike trade? That's the easiest filter here. Liquidity. That's the easiest way to decide between these. If something is liquid and I can trade options, I'm going to favor options. If it's not liquid and options don't look good, I'm going to trade the stock. It's quite literally that simple. So in this case, let's take a look and let's see what it looks like in here. If I go into the trade tab, what expiration would I favor for this kind of thing? Because one of the components of analyzing a breakout is expected duration, how long we think the move may or may not go, and it's going to influence where we land. So there'd be a preference. Short duration. Okay, so how short? Because if we think about duration of moves, there's a simple way to reference what we think may or may not happen. David says 2 weeks. That's not it for me. Definitely wouldn't choose 2 weeks. And I'll explain why for a few reasons. the primary thing is if I zoom this out, and actually to make this even easier, let's do, I don't want a 5-year weekly. That's a little heavy. Let's do a 2-year weekly. Joey says 90 DTE to limit theta decay. Busy says 2 months. Okay, that's more my speed. That's more what I'm thinking. Why am I thinking that? Because David, in your scenario, if I look at these bigger price movements it's had, what do you notice? I purposely am using weekly candles for you to make it a little more visual. But there's a very clear pattern I see with a lot of these big moves, is that it's several weeks long, right? So I see 1 week, 2 week, 3 weeks, 1 week, 2 weeks, 1 week, 2 week, 1 week, 2 week, 1 week. This is a giant week, but it's actually preceded by 3 weeks that also looked pretty good. So the reason why I don't want to use something like 2 weeks is simply because when I analyze the movement of the product, or in this case, the security, it's something that has generally sustained moves at least for a few weeks. So that informs my decision. So my 90-day diagonal is a go-to, but the problem is there's no 90-day. So then what's the next filter? Well, if I prefer 90 days, that's naturally going to put me into one of two spots, right? Either this 15 Nov or 17 Jan. So then what's the next filter I can apply? It's pretty simple. I can see what liquidity looks like in both of these. So if I look at the 15 Nov, I essentially can see that there's 11,000 calls. And then if I go to 17 Jan, there's 26,000 calls. So there's a really massive skew out in Jan. So let's go to Jan and let's take a look. Now, if I'm looking for something that's around a 65 delta, what is this? Gold. 1 sec. I gotta check on my phone so I don't have to get out of on demand. But that's an alert for gold starting to break out, so that might be a trade. Stand by. Yeah, so that is a trade. Give me a second. Right now I'm checking the portfolio. And let's take a look. So today's the 10. Expiration is... I'm going to move you guys over here to my other screen really fast. You guys will be able to see the chat. I just don't want my portfolio details popping up. So this... Yeah, so this actually looks pretty good to me. So right now I'm looking at gold futures. They're up 0.5 point, which is actually a little bit surprising. But support here would be like 26.25. Stop would be like 26.15, something like that. Let's call that 26.15. And then the right now front futures is 49 days out. It's going to be the 20Ds. And then basis right now is like 26.52-ish. So then let's take a look at overall size. Okay. I'm just checking the size right now compared to everything else that I have out. I want to make sure that size is about commensurate, which it is. Okay. So I just essentially shaped all that in the log so that now I'm just going to throw it through on the phone. What is this? 2652. Orders out and we're filled. Done and done. Fulfill. Cool. So now what I need to do really fast is set my downside alert. I'm actually just going to set it via a stop so that I don't even have to bother with it. This is good because I've really been wanting to get exposure here. I'm not in love with where it's at, but like in terms of like total risk, I'm 100% okay with it. I like this. So 26.15 is where the downside will be. And then I'm going to make sure I set the time in force. I want it good till canceled because I want it to go through if it fills in the evening. So I'm going to rest that order. And we're good. Okay. Thank you. Now we will get back into our example. Let me bring you back over here. Back at it. Cool. I'd rather be seeing says Y 65 delta Y 065 seems a little low. No, it could be. So why would I pick a 65 delta in this case? Think of the behavior of a 65 delta versus 70 or 80 delta. There's a specific difference, and it ties directly to the profit mechanism. Closer to price movement. Well, that's why I picked delta above 50. So we already know that. So let's take a look at APP again. Less cost if you move, delta increases. So I'm not concerned about the cost. So it's not that. Compounds faster. So what does compounds faster mean? Shrey J is on the correct answer. Gamma, exactly. So both Shrey J and Joey are 100% correct, which actually leads to the next part of the decision. So if I take a look at the 17 JN25s, the 128 DTE, and I take a look at something around a 65, the gamma is 0.01. If I go to the 15 NOV that are slightly less liquid, but if I go to a 65, which the closest here is a 63, my gamma is what? 0.02. It's literally double. So I actually like the entrance on this better than the entrance on this, comparing the 63 to the 63. Because what do you also notice about the bid-ask spread? This is 1380 by 1420. This is 1140 by 1180. Again, I'm not worried about the cost. That doesn't matter to me because the portfolio has plenty of room. What do you notice about the bid-ask spread though? And then if you take a look at the OI of the specific strikes, you'll also notice something that falls in line with the same answer. They're both 40 cents, right? Like if I take a look at the spread here, 1380 to 1420, that's 40 cents wide. If I take a look at the spread here, 1140, 1180, it's 40 cents wide. Same, doesn't matter. The other thing I notice is that if I look at the gamma, I literally have 2 times the gamma. So for the thesis and for the profit mechanism, this is what makes sense for me. So again, I want to reiterate the point. Do you notice how through this whole thing, I didn't start by saying, I think app is going up. What structure should I use? Right? Like, do you notice how that's not part of the equation here? I'm literally not even concerned about that. What I'm immediately doing is looking at app and I'm saying, what do I think about relative to the movement? What do I think about what makes sense for the expectation that I have for the security? And I start backing into different answers. What strategy makes sense is backed into based on what the profit mechanism is. Then I need to make decisions about the strategy. What DTE is the next decision I need to make? What delta is another decision I typically make around the same time? They all get answered based on a thorough analysis of the profit mechanism, which is exactly what's underway right now. Joey says, what about theta comparison? So the theta here is 7 cents per day. the theta here is 5 cents per day. So you're paying $2 per lot more per day in the 15 nodes. So that's the theta equivalent. That to me is trivial. I don't even care. Doesn't matter to me at all. For this kind of thing, theta is secondary. Like the amount of theta that's coming out on a daily basis is secondary. And the reason why it's secondary is because I know it's going to be light as soon as I'm outside of 65 DTE. So then it's just a function of how light. Because for example, if we looked at one of those other suggestions and we looked at a shorter equivalent, you can see that theta is 11 cents or 12 cents, even for the in the monies. So these you're going to get, you have to be right pretty quickly. Whereas these, I know as soon as I'm outside of 60 days, it's going to be relatively slow. If we take a look at the 44s, it starts to accelerate a little bit on the 90s, but not by a ton. Theta goes up. Now it's 6 cents. So I'm sorry, compared to the 17 Jans. For these, it's actually slowing down a little bit. And the reason is just because there's less theta total left in the options. So that is that. All right, so now we already kind of know what I'm looking at. So let's take a look at a prospective position. Now for this one, I'm going to go through sizing protocols. And the reason why I'm going to go through sizing protocols is just because I want you to have an idea of how I do this. I need to move you over again really quick to the spare screen. I just have to get rid of, I don't know if there's anything in the Analyze tab. Yeah, there is. And I don't want to give any of the answers away before we actually take a look together, because I want to go through the process with you. So let me go to back here and let's take a look. So I've already zeroed in on these 90s. I know I want them. So I'm going to look at them for about 1160. Now, a couple notes. When you're trading at size, and again, the size that I put on this is not, it's really not that large, but it's going to be multiple lots. So I actually will get an average fill, but we'll work through what that could look like. We'll start with a single lot. So let's go to Analyze Trade. Now, let's say that I'm going to define what I want in terms of risk. So we can use whatever size portfolio. It'll mirror the same trade. So we can use the $100,000 portfolio. So in a $100,000 portfolio, I need to figure out where my stop is going to be. So in this case, I have a few choices that I could pick, but if I go out here and I try to get some ideas in terms of where support and resistance has been before, how strong different points are. I notice this volume node there on a long-term chart is pretty significant. And I notice that it holds through actually here. So then to me, that starts to look like 83-ish, maybe a little tighter, 84 and change, something like that, could be used as a stop. Now, if I grab this, I could tell you exactly where I landed for the stop was 84.70. So I used a really tight stop. I'll draw it. And this was the soft stop. That's not the hard stop. The hard stop absolutely would have been a drop below 81, but probably would have been a drop below here after we fall through this volume node. So that would be around 83.5, something like that. That would be the second stop. Okay. So the next part of the game was starting to phase into the trade. So I start by buying, and we'll talk about how that works, but we need to take a look at the risk. So we need to see the risk at 84.70 and at 83.52. So let's analyze this. Let's take a look at those 2 points. I'm going to add 2 to the bottom here, and I'm going to just throw the price in here. So we have 84.70, and let's call it 83.50, something like that. So we can see it's about a $750 loss per contract. So if we have a $100,000 portfolio, what do we think a fair amount of risk here is? Any guesses? And it's completely subjective, because what I can tell you in terms of sizing and in terms of sizing via risk for this specifically, Joey says 1 to 2%. David says 3 contracts. 3 contracts puts us $2,300. So that would be about Joey's 2%, something like that. I think that's okay. For something like this, I would actually, like, I personally would be more aggressive, but I think as long as it's under something like 6%, I'm okay with it. I would probably size something, and for this one, I can tell you exactly what I sized it at. Yeah, so this one was sized at sub 5%. So it's sized at sub 5%. So let's just call it 5% for the example here. Well, actually, no. What do you guys think? You guys say 3 contracts, Joey says 2. I think that's a little bit light. Maybe I'll meet you guys in the middle and we'll do like 3% here. Joey says also could compare IV of the different expirations, just thinking of other quantities to look for. Yeah, you could look at that. It's insignificant. The IV in that case doesn't really matter that much to me, because I'm going to a 65 delta. I'm inherently paying less extrinsic value from the jump, but there's absolutely nothing wrong with looking at that if you're inclined. You can see the way, for example, when that gold alert went off, right? You can see that I kind of know the things that matter to look at, and that's what I'm going to weight in the analysis. But if you want to look at stuff like the amount of theta, for example, it's a completely fair thing to look at, and it's smart until you get a feel for it. So when you look at something like the primary things that are going to influence this position, is going to be direction. Then it's going to be your delta is really your representation of direction. So those are hands down what really, really matter here. Then the other components are, I would consider them for optimization. So it's okay to look at them, but I would just weight them appropriately so that you don't get too bogged down in the ancillary details and stuff like that. That's all. Busy says, have you tried a small portfolio challenge? I did do one a while ago. I have a playlist for it called Small Stacks. And this one. Busy. This is the Small Stacks playlist. I did a $5,000 account. But yeah. In that one, I think I did live with you guys, like live updates. I think I did updates on like a weekly basis or something, and I did it for, I want to say like 3 months or so, something like that. And I think it was profitable. I don't remember. I think it was profitable, but I don't remember. I really don't remember much about it, but I remember doing it. That did happen. I want to say it was like maybe, it wasn't too much, but it was like maybe over 15%, maybe 15 or 20% or something like that. That sounds right. That's my guess. Like 3 months on a small account, something like that. Reese says, then you remembered it sucks being poor. Yeah, that was one of the funniest things about doing that, like how annoying everything was. Because I mean, you can tell, honestly, even when I was sizing this position and I said that the cost doesn't matter. It's a luxury for that not to be a massive input. Because in this case, the cost really doesn't matter. But now, actually, let's use the $100,000 portfolio, though, as for the example, because cost does matter if you have $100,000. You run out of that real fast. So if we look at a 4 lot here, you're going to use $4,800. That's actually okay. That's actually a kind of a Goldilocks scenario where your cost and risk just about line up that neatly. But for something like this, I would keep it less than 15% of the portfolio in total. And that's just 15% in terms of utilization to leave room for other stuff. But other than the utilization aspect, I'm mostly going to size this off of risk. That's what matters to me the most. So this is the $100,000 variant of the trade. And then I'm going to create a duplicate. And then what I ended up coming in with was a 25 lot. And I ended up with an average right around 1160 because I started a little bit before this, a little bit after this. It was like 1160 and change. But that's the position that I ended up with. So now we fast forward. We go to 12 step. I'm not going to go day by day for the whole thing. We'll speed up a little bit, but I want to go day by day for the first beginning because this is kind of like the embryonic stage for it. So what's the move here? We have APP. It starts rallying. It ended up rallying super hard the rest of the day. And then it ended up gapping very slightly the following day, and it's been rallying super hard again. So a couple admin notes is this trade, I essentially came in with the size that I wanted right from the jump. If I wanted to scale, this would have been the day that I scaled. I didn't in this case. I started with the risk that I wanted. But if I wanted to start a little bit lighter and then build into it, which is kind of common for me, then this is the day that that would have been done. The reason why I wanted to come in with the risk being defined from the jump is just because I viewed this as a lower risk entry than waiting too long. Exactly why. Because I already knew that it started rallying pretty hard. It's a higher risk in terms of a pullback, but I didn't view it as massively high risk in terms of the size of the trade. If I wait too long to size in as much as I want, then I would have been much higher risk total to the account. So if I did do that though, from a hypothetical, this would have been sized, this entry would have been sized probably 70, 75%. And then this would have been the remainder, something like that. James says, can I ask the reason why you were sizing more aggressively? Are you sizing more aggressively because of positive expectancy or because this asymmetric return since you're playing a breakout? This actually isn't like, this isn't that size, that aggressively sized in my opinion. So I don't actually really view it as super aggressively sized. Joey says, do you have these notes in your trade log on reasons why you decided to do things outside the structure of your plan? I mean, it's not really that far outside the structure of the plan. Like the main deviation was just the entry. And that's like a very standard entry criteria for me. So if there's something I'm eyeballing that breaks a level I'm interested in, and then it's coming in looking like this, it's very, very common that I'm going to enter on that day. And it's, again, because I've looked at tens of thousands of them, and I know that very frequently it will look like this. Now, that's really the only big deviation. The other deviations, I mean, 90-day diagonal, like in terms of DTE, 65 delta is super close. That's very, very common for me now. So yeah, there's not really a bunch of things that I can think of that deviated from like the written out plan. The main one for the plan definitely would be entering here versus waiting for the close, because that is the preference, is to wait for the close. But it's one that I very, very frequently will bypass, again, specifically given the volume condition. Reese says, I find I usually wish I'd gone heavier at the jump. Yeah, super common. Because the thing is like, the only reason not to go heavier at the jump is that if we're really unsure, and then that begs the question of, should we take the trade? I don't really think that it's super wise to leave a bunch of money sitting on the side to scale into things if you're waiting for an entry and then you see the entry. So there's definitely merit to scaling. I scale a lot, but I think it's generally prudent to come in at your first entry at the larger scale size and then move around from there. Joyce says, I mean, all these details of at each day specifying what you were thinking at each step is your plans. Yeah, no, I mean, also these details at each day specifying what you were thinking at each step. To me, yeah, it's like, it's kind of like driving, right? Like this is what I trade over and over and over and over again. It's why I have the defined profit mechanism and sub mechanism. So it's not like I have to like refer to the directions to figure out where I'm going. At this point, it's generally codified. So the amount that I actually like genuinely crack open my trade plan and refer to it to remember something is very infrequent. I crack open the trade plan most of the time to update information in there as like a log. So yeah, most of it is very, very much just based on the continual application of the same thing. That's all. Like it might sound like there's a lot of decisions, and maybe there are, but when you go through the process so many times, it really doesn't feel like a ton of decisions. It feels more so of like just kind of going through a general flow. Ree says, like chess, if I see the position, I know what I played. Yeah, because you kind of will have your tendency. Exactly. It's very similar to that. So now the question is, what do I do today? Any guesses? There's a big move. I already told you I came in at the size that I wanted, but what's next? Do I come up with more money to scale in more, even though I kind of started with what I thought I wanted to put on? Or do I do anything in terms of taking profits? Because it already has shown a really nice move, if you think about it. The move that it showed from when I entered would have been, what? It was like 93 and change, a little less than that. And it's ready at 104. Joey says move stops to break even. David says start scaling out. Yeah, great points. So the main thing I do is move my stop up. And I don't move it up that much. The reason why I don't move it up that much is because I think we're in the general beginning of the move. So what I do is I try to find a good volume node to anchor off of, which in this case, it becomes right about here, becomes the soft spot or soft stop, sorry, 91.67, something like this. So I'm going to remove, well, I'm going to keep the breakout so that you can see it, but this is where the stop goes up to. So essentially the stop gets moved from 83.5 and 84.7 to 91.67. And then an exit would probably occur somewhere around 89.5. So I don't move it to break even because I still want to give it room to move, but I absolutely take advantage of the movement and start to slide the stop up so that total risk is much, much less. So for example, at the onset of the trade at my size, it was originally, I want to say like 18K in risk or something like that. So let's analyze and let's take a look at the original stop of, what was it? 83.5, something like that. Yeah, it was like 18 or 19K, something around in there. So now with the updated stop being somewhere around like 91, let's call it 91.5, it essentially cuts my risk in half to 9 grand. So the overall risk in the trade comes down massively. Now for Cedric, the reason why I don't use a trailing stop is because to me, trailing stops are arbitrary. I don't use a random percentage off the stock, and I don't use a random percentage off of my profit. I like to use support and resistance because things tend to move pretty heavily. Like this is a good example of something that's outside support and resistance. And you'll see that it has these big movements. Very, very common. And then stuff that's trading around support and resistance, like this entire blockade here, much smaller candles and much tighter movement patterns. And that's just because there's more buyers and sellers willing to transact there. So Cedric, that's the reason why in this case, I didn't use a trailing stop. I essentially mentally am trailing the stop myself. That's kind of a way to think about it. I think Mel has got her order in. I don't know. She didn't order. B. Williams says, I have a question about stop losses. I was trying to do one, and is it true that stop losses cost money? No. It's just an order type. Anytime I try to do a stop loss on my options, it seemed to have charged me more money. No, I don't think so. I don't think that. Yeah, I mean, you have to check with your broker, but it's just an order type. You might be seeing it reflected in the fill that you got. You might have gotten a different fill than expected, but I don't think so. So what broker do you use? Let's fact check it really quick. I'll look it up right now. Fidelity. Oh, I can't imagine that they do. Does Fidelity charge for using stop loss orders versus limit orders? I would be shook if they did. I am asking ChatGPT. I reference that simply because I don't know how accurate it is. Fidelity does not charge extra fees for placing stop loss versus limits. Yeah, which makes a ton of sense. Because again, it's just really, really not common for that. It's straight up just an order type. Like that's all. So yeah, I think that's why that's the case. All right, dinner order is placed. B. Williams says, I don't think you're doing anything wrong. You might just be getting a fill somewhere different, or you might be seeing a fee that you're not used to seeing or something. But yeah, there's not going to be a fee for it. Okay, so now we have the stop moved up. And again, we've essentially cut risk in half. And again, if you remember what I walked through when I had that trade on in the rut, this is essentially, this is literally like essentially the same fucking thing where I'm just trading the breakout and I'm moving my risk with it. Now, notice the other thing that I started with. Do you remember the first trade that I reviewed with you with Nike? What I'm highlighting is that I'll take losses fast. And then when I have winning trades, especially for this specific strategy, this specific profit mechanism, you have to let the winners go, because the winner has to overcome all of those small losses that accumulate from being wrong, like I was in Nike. So that's one of the reasons why I'm not scaling out yet, because it's still showing a lot of strength and it's moving the correct direction. Okay, so let's fast forward to Friday and then we'll start doing like midweek updates. We'll go a little bit more. Same. Another continued rally here. B. Williams is now retracting all his messages. It's okay, B. Williams. You don't have to feel weird. You don't have to like take your toys and go home. You can ask that question. Move stops up a little bit more. So where do the stops seem to make sense now? Because again, I told you I like putting stops at support and resistance. We ain't got much of that right now because we are in free fall breakout. I guess free falling up. Where would it make sense to move a stop? Previous lower zoom out. Yeah, that's a good spot. So what I'm doing is I'm using the volume nodes. So the only two volume nodes I see are right here and right here, right below these. But I also know the tendency, if price falls from here down to here, it's almost assuredly going to come down here, almost assuredly. So then it begs the question, is it better to have a tighter stop? Or do I think that it might have a slighter pullback to something like here and then continue moving up and out? So what I do in this case is literally move stop up to break even. So it's like 92-ish, something like that. So now stop. I don't think I have to draw it. You can essentially use the breakout line for where the next stop point is, like somewhere right in there. So I'm giving it tons of room, tons and tons of room. Now, this is hard stop. If this started rolling over, and I think that it's aggressively rolling over, what do you think I do there? Don't think binary. Bounce? No, incorrect. I had a feeling we would think binary. Nope, incorrect again for David. Scale out. Exactly. Reese and David then understood what I was getting at. I would just scale out a little bit. I don't have to take the whole trade off, because what I can do is, let's say that it starts rolling from here to here. If I take half that trade off, let's take a look at the example. So right now it's trading at 112. Let's take a look at 106. At 106, if I take half the trade off, I would make $18,600. So at that point, what could I do? I essentially could take half the trade off. That would leave me with 12 lots, and I have a risk-free trade. Let it go. That's all. So when things are moving in our favor, we don't want to jump the gun. We do not want to jump the gun. Now, there's one other thing that I use all the time in these instances, specifically for managing risk. What technical indicator can I use for that? And then I realize I have to add this to another playlist for trade management. Where's this at? Here. Any guesses? 10-day moving average, 20-day moving average. I would start using moving averages. So that'll be the next tool. Yeah, so Joey's on it. So I wouldn't use RSI for risk defining personally, but I definitely use it to track momentum, which obviously you could tell tons of momentum here, but I would use the moving averages as other exit points. Okay, so now let's fast forward a few days. Let's go to the 18th. Let's see what's happened here. Now what? Rally, literally 5 days straight rally, hits high. What happens now? I see RSI starting to flatten, but still RSI is above moving average. Moving average is still positive sloping. This I'm going to change to a 10-day because that's what I was using. So now what? We entered in here on the 11th. It's now the 18th. 1 week into the trade. Joey says, potentially profit takers can drive the price down. If you scaled out, maybe let it go. Ree says, I'd take some profits, so I'm assuming you'd let it run. Any other guesses? The way that I look at it is I'm now sitting on a decent profit. I don't have to top ticket, but I don't want to give up the move. So what I can do is slide the stop up to 102, something like that. Now I'm essentially just using the moving average, short-term moving average, which in this case is a 10-day. It would have a few nodes that it has to fall down through. And at this stop, it would lock in a profit, you know, provided that there's not a massive gap that takes me all the way down. Now for gap risk analysis, I use some comparables, and I can use the average true range to help me understand what that looks like. So I can see that it's like 5.6%. So I'm actually not worried about a big stop here, meaning a big gap crushing through a stop. So what I do here is take a look at the Analyze tab and I say, okay, the trade's showing about 41.6K. I can take some of it down here. And right now, those are trading for the 90s are now at like 35-ish, something like that, 35.25. So now from here, I can pull some down. There's not a lot of extrinsic value left because they're falling so far in the money. They're essentially at a 90 delta, or I can let it go. What I end up doing is just watching it very closely. And I actually set a soft stop up here for a partial profit. So I wanted to give it as much time as I could. So what I ended up doing, again, I watched it all day. I'm going to fast forward a day so that we can look at what it did. Right? But I didn't take anything down. The game plan was that if this started trailing down below this 116 and like 3/4, like essentially I used the midpoint. It was a little higher than that. It was, I'll show you exactly where it was. Essentially used the very base of this volume node over here. So that was 116.90. So if it started dropping there, then is where I essentially would take some down. And how much would I want to take down? Any ideas? Because right now there's 25 lots total. So that gives me pretty easy scaling numbers to work with. B. Williams says, is there anywhere I can send you a screenshot on how the account does the stop losses? Yeah, you can drop it in the page, or in the you can drop it in the Discord if you want, but I don't think you're doing anything wrong, because again, like there's no fee associated. So I'm not sure. Yeah, I don't think you're doing anything wrong. There's nothing to do wrong because there's no way for you to like add a fee. So what size? David says 10. Reese says half of 25, but it's an odd number. B. Williams says, I tried it again and it's showing a lot more money when I do a stop loss. Yeah, you can drop it in the Discord and the folks can take a look. But yeah, my guess is you're just not reading something right, because again, there's no fee that it would tack on. So if it started falling below here, James says I would take maybe 15, 20 off because I don't like the red candle. Scale out enough to lock in profits and ensure the gain, let the rest ride for a bit. Yeah, so I wouldn't have to actually take that many down to lock in a profit, right? So if we take a look at where it's trading now, it's 43.3K. And I bought them for 1,100 each, right? So what I do in this case, prepare to do, is I would literally just take a third of them down. There's no reason to take too much. The move is still on. There's nothing that says that it can't consolidate for a little while. It should consolidate for a little while. And then if it holds the consolidation, that's typically the preemptive move before the next move. I already have the position on. I have a basis that I like. No reason to start messing with much of anything here. Now, for context, my dinner got picked up. Perfect. So now let's go to next Wednesday. What's happened here? Essentially one-sided rally. You know what I'm happy that I didn't do? I'm really happy that I didn't start taking the position down here And I'm really happy I didn't start taking the position down here. Now, it's easy to say because it's going my direction. If it had gone down here, do you think I would have been happy if I took my position off here? The answer is no, I wouldn't have. Because I sized the risk in the trade in the opportunity from the jump as I wanted the risk to be. So there's no reason for me to start worrying about the risk after it starts moving in my favor. I still already have the risk defined as I want it to be. I was okay with that risk when I entered the trade. So I'm not going to let the profit that I'm sitting on now contort my thought process into changing from my original concern, which was this risk. It's on, it's moving. Now what happens here is the stop moves up. That's all. I'm using the 10-day, and the 10-day neatly falls below this primary volume node up here. That's all. So now let's go to October. What do we notice? It's rolling sideways, exactly as anticipated. Things that have these big up moves are going to consolidate at some point. It's going to happen. It might be a long consolidation, it might be super short, or it might be a sharp reversal, but it's not going to go up into perpetuity. The expectation for me was a consolidation. So now we can see that the 10-day moving average hasn't been violated to the downside. I'm specifically looking for a close or a large move below. Neither of those have happened yet. So now let's fast forward as far as it'll let us go. And off it goes again. So now stop comes up here. And I'm going to come out of on demand so that you can see what it's doing today. So the last you saw was what? The 8th? Something like this. So now it's just rolling sideways. 2 more days. Guess what happens now? All these can go away. Yeah, that's fine. So now the stop literally sits here. And I literally deleted my alert so that it didn't give it away from when we started. But that's literally all it sits at. There's an interesting new problem though. And this is something that a lot of people don't pay attention to. So if we go into the trade tab, what do we notice about my DTE? We only got 36 days left. So normally I would manage it when it hits 30 DTE. Why would I normally manage it when it hits 30 DTE? To manage my extrinsic value. That does not apply in this scenario. The reason why it does not apply is simply because there's no extrinsic value that I care about. There's $40, maybe if that. Very little extrinsic value. So very little concern about the extrinsic value because there's just not much to come out of them. They're so far in the money. Normally, I want to avoid that as I go in here. Reese says, is liquidity getting worse though? Liquidity will get worse and better at the same time. So now you'll see that it's 1.2 wide and it's over a 1 delta. So the liquidity itself definitely will contract, but it's not bad at all. Because if you remember when I first got into it, it was about 40 cents wide. And as things go further and further in the money, they're going to obviously widen out a little bit. So I have to think about as what to do here. I have 36 days left to run with this thing. So how would I do this? Super, super simple. I think Shrey mentioned it earlier. Offer short calls. It's exactly what I'm doing now. It's exactly the move. So now let's go back into on demand so that I can show you how I figure out what short call profile to offer. So let's go back to the Analyze tab. We'll get rid of this 4. Let's add another price tab. Actually, let's change this price tab. And APP, what was it trading at? I don't even remember. What did it close today at? 145. I forgot. We can do it right in here. So with this hanging out right around 144, if we take a look at current spot price at 144, which is here, the trade's at like 109.6. So now what I can do is tinker with selling short calls against it, but there's a couple choices that we have to make. The first thing is expiration. I'm obviously going to want to keep it shorter term in duration. I want to use less DTE, and that's just because I'll make more money on it. So now, if I look at the 8 DTE, they're like 20 cents wide. If I look at the 15 DTE, they're like 50 cents wide. This is $1.10 wide. So these are terrible. These are not going to happen. So that's naturally going to move me into a couple choices. These are like $1.30 wide, right? Like the weeklies are terrible in here. So I'm either going to be able to do the 18 oct or the 15 nov. I'm going to pick the 18 oct. Then in here, I now have a delta choice. What delta should I pick? The trade-off on the delta is the higher the delta, the more money I'm going to make in the credit. The lower the delta, the less money I make in the credit, the more upside profit potential I get. But I'm purposefully using this as a way to get paid to scale out. Because do I think that it's going to continue a parabolic up move? Genuinely have no idea. But I don't want to sacrifice too much of the up move here on the short calls, but I do want to start taking some of these short calls down. So it's essentially coming in something around a 30 delta, 40 delta. Try to find something that's at least somewhat liquid. The best liquidity is here at the 146, but that's too tight. The 147 is still too much. So what I'm going to look for is something that's around a 30 delta in here. Now, when the market opens, these will be a little bit more liquid. So literally tomorrow, what I'm going to do is pop into these 150s probably, and I'm going to sell them. How many 150s should I sell against the longs? We already know the calculus. The calculus is the more I sell, the more I make up front. But at this point, I really don't care because I've already made the money. The trade's already done what I want it to do. So the next move here is actually pretty simple. I look at what would I want to scale out at what price, and then how much of a loss would I take between the difference between these. So closed at 141.10. My stop is now at 136.70. So if I look at 136.70, I would make 89 as compared to where we're at now, which is 109. Like 20K. It's a little more than I would want to give up. So really what happens now is I sell maybe 8 of these. About 8. Now the downside to doing 8 is, let's say that we get another 5% surge. Profit will go from 127.60 to 124. I'm okay with that because I'm going to make $800 on this. I lose essentially 2.5, 3 grand. That's an okay trade-off at that point. And then I would look at just starting to fully scale out. Now, because they're so far in the money, almost all of the rules don't apply anymore in terms of minimizing extrinsic value, theta, because there is so little. It doesn't matter to me, essentially whatsoever. Literally doesn't matter at all. So then if I do start to see it roll over though, and again, that MA is at 137 or 136.7. So what I do is I set another stop here, and I'll zoom in a little bit so that you can see both of them. I guess I have to zoom in more. There you go. So I set another stop right below these levels, and this is where I would start scaling out. So even before it hits this stop where there would be a full exit, I would literally start scaling out at 140.5. And if we take a look at 140.5, that gives us about 100K. So we sacrifice roughly 9K profit potential. But that would be offset by a little bit. We would have $800. So then it takes it to about 8K. But the difference here is that it also gives me an ability to extend the duration of the trade just a little bit more while starting to collect some sort of premium up front. So that is the move from here. And that is the APP trade as it sits. Literally nothing special. But what I'm doing is the same thing I talk to you all about pretty regularly, which is looking to trade these different kinds of breakouts and breakdowns. Sometimes they run for a while like this one. Sometimes they don't run for long at all like Nike, and I get stopped out within a week. It is a game of placing trades that make sense and offer good return on the risk. That's the application of the system. That's all this is. It's literally applying a basic leverage directional strategy that absolutely does use both leverage and short premium, but the system itself is what it is. So David says, LOL, only 100K profit. That's the problem though, right? Like you guys can't be enamored by whatever the fucking coin units that come out of the machine are, right? Like it's just fucking coin units in a machine. The thing that matters the most here is the system, and the system literally is as basic as it gets. Trade something that's going up that looks like it's going to go up more. Like that's about what this boils down to if we distill it into its core concepts. I think people get too jazzed up and confused about things moving, and then it starts to just change the way we make decisions. So even stuff like this, right? Like if we take a look at something like RSI, people will be flipping their shit. They're like, whoa, RSI's been, redlining. It's definitely above 70. You'll notice that I literally don't even use 70. I use 80 for a reason and make it even further out of the way. And it's been essentially just redlining up here forever. But I'm not going to take profit based on RSI. I'm just going to use it to understand the relationship of the momentum. And the momentum is still good here. It definitely slowed down here, but the moving average was still very, very slightly positive sloped in here. So even though it looks flat, it's not. The moving average was still showing some level of positive slope. So it's just a matter of sit and watch. So the biggest thing I can offer to people with stuff like this is avoid the disposition effect, which is so commonly what happens to people. Literally, it's one of the most common things that you'll see them do is take their profits down as soon as it starts showing the fucking profit. And then guess what we do? We decrease the profitability of the system. If you're okay with, again, that's the nature of this specific system, breakouts. I expect to have a low win rate. My win rate on breakouts might be 30%, 35%, something like that after cost considered, sometimes maybe 40. but it's not high. And it's because I take losses super fucking fast because I know there's shit like this, that if it starts moving, it can move in your favor for the vast majority of the time. And then it's an easy fucking trade. What's really difficult is when you're trying to trade something that's moving like shit and you're trying to rationalize staying in. Should I get out? I hope it does this. Maybe this news will help it. That's fatiguing. So I set the P&L metrics right from the jump and then literally respect them, adjust them as the trade goes. I accept that this is a low hit rate strategy, but when it starts to move and show strength, I follow it. That's pretty much all there is to it. So the original game plan was to wait until the trade was done and show like a total end-to-end recap. But I honestly didn't expect to hold the trade for this long. The trade's been going definitely longer than anticipated. I thought it might be a few weeks. So this could be an interesting case study on essentially coming up on options expiration and still essentially wanting to be in the position, but running out of roadway because of the DTE I selected, which was just over 60 DTE to start. So that's APP. It's time for me to go eat some Panda Express, get my grub on. But as always, if you guys need anything, let me know. Like I said, I'm going to keep doing some of the pro sessions open for everybody to walk through stuff like this, because I genuinely hope that it's helpful to go essentially just step by step through a trade and how it's doing. Oh, I think there's a lot of opportunities right now, and it's both upside and downside. I'm adding more and more downside stuff to offset a lot of the leverage long side. So that's the game plan. All right, gang. If you need anything, let me know. Be an outlier. I'll see you all later.